Tax planning mistake number 10. So we're getting down to the end of the wire here. The failure to reimburse employees for business expenses using an accountable expense reimbursement plan or other methods to pay for dependent care, medical premiums, and medical expenses on a pre-tax basis. So if you look at the whole idea of an accountable expense reimbursement plan, if you're an employee of a company, so you might have salespeople working for you, and you pay them to drive their car, and if you don't necessarily reimburse them on a per mileage basis, and if you don't do that, then guess what? They have to try to claim that deduction on their personal tax return. It's a Form 2106, employee unreimbursed business expenses. It's a miscellaneous deduction. 2% of their income is not deductible. Okay? They have to take after-tax dollars after they pay Social Security taxes on that money. The company pays 7.65%. The employee pays 7.65%. So, again, if you don't try to structure an accountable expense reimbursement plan, it has to be in writing. That's the only basic requirement. There's some guidelines you got to follow. But it's a great strategy to have employees paid on a pre-tax basis for their car expenses. And we'll also try to maximize, because medical expenses are so expensive, to allow the employee to pay for their health insurance. Even if they pay for it, we can do a cafeteria plan, a Section 125 plan, that allows the employee to use their compensation to pay medical premiums on a pre-tax basis. There's some special rules with Obamacare, so you got to be careful about that. There's also other strategies. It's called a health reimbursement account, a flexible spending account. These are all terms that you need to discuss with your CPA to try to identify whether you should be working with your employees to maximize them having these expenses on a pre-tax basis. When you do that, the company saves almost 8% in Social Security taxes. The employee saves Social Security taxes. This goes back when I first started in accounting. I had a car allowance of $300 a month. I had to account for my mileage on a pre-tax basis to my employer, and so that income was tax-free. It's not that hard to do it. It takes a little bit of effort, but you really can save some good money depending upon how many employees you have. Okay? Also, if you're an S corporation, you're a business owner. You want to make sure the company reimburses you for all of your business expenses, because you don't want to try to deduct it on your tax return. Remember, 2% is non-deductible of your income. So as a business owner, you want to reimburse yourself for mileage, for travel, for entertainment, and all those goodies, and you put it on the corporate tax return, which is not audited. Okay? When we have clients that are audited for these employee expenses because the company doesn't do it, the IRS takes the position, they say, what's your company policy? And they've taken a position now that they say, if the company doesn't reimburse you as an employee, we think it's unreasonable and we're not going to allow the deduction. That's the position they're taking now. So they've even taken a step further. They're saying that you can only deduct ordinary and necessary business expenses. And they're just coming out of the box saying, you know what, for audit purposes, if we audit you on unreimbursed employee business expenses, it's unreasonable. It's not necessary because the company policy they made a determination when they didn't reimburse you that it wasn't reasonable and necessary. Isn't it crazy?